Okay, we'll just wait 20 more seconds and then we'll kickstart. And here we go. Let's get started. Once again, welcome very much to everyone who chose to join in to learn more about accounting and audit in blockchain. This is something I personally really have been looking forward to as a background, as an auditor, accountant, and worked in financial department my whole career. This is something that means a lot to me. It started out with discussion amongst us on what was actually the best practice. Learnings, what should we actually think about. We started out doing a best practice guide for head of finance and CFO, and doing these conversations with the people you can see here as panelists. We then decided to say, let's share our knowledge. So today I'm really happy to have Thijs, Kasper, Christopher, and Augustus joining. We will have time to hear a lot more from them and as well get a proper introduction. First of all, I want to introduce Nordic Blockchain Association. For the ones that haven't met us yet or done anything with us, we are a non-profit organization that existed since 2017. We are focusing on educating about blockchain, ledger technology, and Web3, maybe Web4 soon, but the whole thing is this blockchain and the technology behind it we really find interesting. What we're doing on a more tangible level is that we try to engage both with the community, but as well with the establishment. The way we do it is that we do monthly meetups and online webinars. This is one of the webinars. We do industry roundtables and tailored event. This is where we as industry can sit down and talk to other industries. So we in closed environment can kind of talk about the technology and figure out some good solutions going forward. We do public and social engagement. As the Danish audience may have been seen, at least on our SoMe channels, there's been quite a lot going on in regards to new crypto scat. The whole community have really got together, and we had some really good dialogue with the public elected and as well the relevant ministries, and that actually managed to get it postponed, or at least have a roundtable where the relevant parties could talk about. And that's some of the initiative that we're doing as well. And then we got our flagship conference, which we do once a year. The way we kind of like, again, on a more, let's say, tangible way where we try to do different is that we got steering committees. We've got a industry finance steering committee, legal, best practice, and sustainable and inclusion. This is part of one of the initiatives we did actually in the steering committee. So when we're talking about, like, as I did with the people around here, when we talked about something we could do, it was through some of our roundtable that then led out to this webinar. We are present in the Nordic region. We are quite heavy represented in Denmark, but as well, we got board members from Sweden, Norway, Finland, and Estonia, where we do meetups as well. We've got one in Oslo coming up, Mika. We actually have a roundtable at Davos right now. So this is just showing that it is a Nordic association where we really want to engage. Today, we chose to focus on Danish law, but hopefully we'll be able to take this webinar and do it in other countries as well. We got our upcoming conference, which this year would be in Stockholm, which we're really excited about. The last 6 conferences have actually been in Copenhagen. This year would be in Stockholm at the Epicenter. We expect around 1,000 participants. So if you really want to learn more and get to know more people from the region and as well from specific vertical industry, this would be the place to be. Back to the agenda and the reason why we're here. We kind of started out, what is the role for head of finance and CFO in blockchain? That led out to this agenda. Of course, we'll introduce the speakers. Planning and consideration, that's where I come in with my background. Then accounting. Then we want to go through audit, legal process, and Q&A. I would like to start briefly with introducing the speakers. They will do a proper introduction when they're doing their presentation. But to begin with, if I briefly introduce myself, my name is Jacob. Besides being the CEO of Nordic Blockchain Association, I'm educated as an auditor and worked 15 years in finance department, only 2 years as an auditor. I must have done hundreds of audits in the companies that I've been part of, done everything in blockchain related, everything from smaller companies, but as well, I was a partner at a VC firm for 4 years where we had a portfolio up to 60 companies. So I've been really engaged in blockchain audit process from the company side. I will do a little bit presentation on that, but I'd like to hand it over to you, Thijs, and do a brief introduction.
Yeah, thank you. Greetings, everyone. My name is Thijs. I'm 31 years old and a state-authorized public accountant. I work with many businesses, both with and not within the crypto industry, where I create value through active sparring with the management and also by sharing the insights about their financial statements, which we often understand during the audit.
Thank you very much. Kasper?
Yes, my name is Kasper Den Andersen, and I'm an assistant attorney at Dale Law Firm with a law degree from Aarhus University. I began my interest in cryptocurrency 6-7 years ago, and started my interest for taxation of it around late 2021, where I wrote a master thesis about trading cryptocurrency called handelsnæring in Danish, in regards of the taxation there. So I am a tax and corporate specialist at Dale, and we have a lot of cases regarding cryptocurrency taxation. And I would like to introduce Christoph.
Thanks, Kasper, for the smooth transition. So my name is Christopas. I'm representing Baltic Assist. I'm one of the finance partners here. I've been in Baltic Assist for 7 years, which what it means is basically I'm responsible for a portfolio of clients and with a team of over 40 people. And yeah, I have a background in finance, worked in sales previously, and with me together also is my colleague Augustus.
Yeah, thank you. Hello. I'm Augustus. I worked in Baltic Assist for already, I think, 8 years. And my interest in cryptocurrencies pretty much started actually last year, once we got the opportunity to work with few crypto trader customers from accounting side. And then we had to find out all accounting aspects really quickly, so to say. Thank you.
Great. Thank you very much. We'll go to the first agenda point, which was actually a longer presentation of 15 slides. I'll only do one because they are more informative, and I rather want to hand over the time to the rest of the people here in the panel. I think the important part, and this is based on my experience as CFO/head of finance in blockchain companies. Overall, it can actually be, and I say actually be, extremely easy process if you plan it correctly. Kind of my 3 main learnings that I have done is that audit, when you're in such a regulated space, is more than just an audit. So I really recommend when you're starting out the process, it's kind of alignment from a C-suite perspective. Why do you have it? In some cases, and it depends on what you're choosing from an audit perspective, you can have quite, let's say, close books. You can show to disclose as little as possible. But as well, when you're operating in an industry, I would as well recommend it would be really good to consider other reasons why you're actually doing the audit, especially to show that you have a good environment for security and in general just handling transactions. So I would really recommend that you go and have a good chat on the C-suite level, figure out, is there anything needed from partners? Some partners need good audit reports, branding clients as well. What really helped me out was engage quite early with specialists. I think we now have the 3 right kind of experts right here, which is of course the auditor, the accounting, and a law firm. But here goes for blockchain, there's other third parties as well that could be really interesting. See my experience in the fund, having due diligence provider in there, having a KYC provider in there, it just help out making sure that the audit goes a lot better. So engage with third-party specialists is really good advice. And then, of course, manage expectation with auditors. I think I have some of my worst and some of my best processes in audit with blockchain-related company. And the worst was by far where I didn't align with auditors, especially, meaning that I thought something was extremely important, so I spent quite a lot of time on it, but they actually had other points of view, and that actually meant we had to restart some of the things. So basically go in and talk to all your parties to figure out what is actually needed. And that goes into plan the audit process in advance and educate. And this goes as well, I call like pre-audit. So there's always an internal audit process, at least the way that I like to operate with it, where you take into consideration what is actually needed for the audit, but how can you actually put it into your ongoing operation at your firm. On the right side, I made a longer checklist of things that I normally considerate when I'm starting out, like when I get engaged with a company, just things I would like to be aware of. As mentioned, I don't want to go into each of these different bullets, but I'll just highlight some of them. And if you want to have the presentation afterwards, feel free to reach out. But in general, like preparation and that accounting process, that's where it starts for me at least. I really want to make sure that my accounting is aligned with the audit process. Financial reporting framework, it's in blockchain, a lot of things is looked at as a financial transaction, even if it's just internal, maybe it doesn't have a financial transaction. But this means that you really need to think about, well, what is the format that you're operating with? And again, the reporting format, think about something you're already using. And the blockchain specific consideration is that you need to be aware of something that's might not be important for you, which is on-chain. Maybe it's not relevant for your business model. Maybe it's not something you're paying attention to. This could actually be something that's quite important for the auditors. Could be you're using a third party to hold your assets. You know it's a good partner, you know all these different things, but you're basically putting your assets somewhere else. So you really just need to consider it. And the revenue recognition, I would say a little bit more classic, but again, with the SaaS model as an example, right? I mean, is it annual revenue? Is it monthly? When you recognize it? The next thing would be risk and data integrity and IT control. They're not the same, but from an audit perspective, I would really look into your IT controls and data integration. Taxation, I don't want to go so much into. I'm sure Casper will do that. Disclosure reporting is just like make sure you have alignment on what you're allowed to report and not. Third party, and then we'll have the audit evidence. And the reason why I write audit evidence there is that when I mentioned it could be extremely easy to do a blockchain audit, this if everything is on-chain, like there's full transparency for all data. And that means if you show all this data for the audit, like in best case, the audit can become extremely fast. But as well, if you basically plan it in, you will have a framework for the year after. This would be my, I would say, very brief introduction. Overall, where we can look into these things is saying like plan with your C-suite, make sure you engage with specialists, make sure you really plan it ahead. I had a list of things to consider. It might be different from each company, but I would go out and really try to look through everything, every aspect of your company before you engage. I will now just quickly go by all these slides so we don't spend too much time on this, and then I actually would like to hand it over to Team Baltic Assist. And to do a good handover is saying that like at least from a head of finance CFO, like everything starts with accounting. Accounting is where all data comes in. So you really need to have, first of all, a good partner, but as well, you really need to plan your accounting, else the audit is going to be quite complicated. I think that'll be the final word, and then I'd like to hand it over to you, Augustus and Christopher.
Okay. So thanks, Jacob, for the intro and the presentation. And so me and Augustus, we are from Baltic Assist. For most of the presentation, Augustus will be speaking because he has much more hands-on experience with cryptocurrency clients. In the beginning, we will just speak a little bit about who we are and why we are speaking here, and then Augustus will, of course, jump into cryptocurrency matters. So for 1 minute, I will just give a brief introduction about Baltic Assist, especially for those who have no idea what is Baltic Assist, and then Augustus will take over, as I mentioned. So in short, Baltic Assist is a different service providing company, and we have different departments, and one of the bigger ones is the finance department. So we were founded in 2015. Mostly we are based in Lithuania. Of course, our clientele is all over Europe and some part of other continent countries. So in this slide, as it mentions, that we have over 220 employees, but in our finance department there's over 120. So just to illustrate, when I joined 7 years ago, and when I joined in finance, we had about 20 people, and now in finance department we have more than 120 people. So our employee base is in Lithuania, but we also have a representative in Denmark who you can meet live, and also we have some employees in Poland as well. So as mentioned, so our growth is steady, but you could say exponential, because every year we grow like more than 30%, and as a result, in 2 years we always grow almost twice. So Baltic Assist provides financial services, mostly accounting, and the biggest chunk of our clients is in Denmark. However, quite often clients have multi-entity groups, and we are not limited only to Denmark. In Denmark, we provide full scope accounting together with other financial consulting, financial controlling services. And of course, we cover other areas where needed. We work with local auditors and consultants. So that's a short introduction of Baltic Assist. Previously, our brand was not that known, but now we are getting more famous, and especially in Denmark. So I just gave a short introduction, and now I'm basically handing over the floor to my colleague Augustus.
Yes, thank you. So on theory and practices of blockchain accounting, well, to begin with, I would like to say that crypto accounting is as straightforward as basic accounting. We just need to remember few things and keep, let's say, it written down under accounting policy, keep structure and consistency, and this will help to everyone, to accountants, auditors, everyone who is in one or another way involved in company management, let's say. So to emphasize, I would like to state that company accounting policy is a must, and you must indicate, let's say, how to treat crypto assets or cryptocurrencies in accounting. Then communication is a key to success, and what I mean by this is that for accountants, it's super important to understand the business model, revenue streams, how company operates, what kind of, let's say, blockchain it is used, what kind of crypto wallets are used, and so on. And last point is choosing exchange rate source and sticking to it. It's straightforward because company cannot change this, and it's super important for successful accounting. Now, on accounting policy, there are two possible options how to treat cryptocurrencies. So to say, you can choose to account it as intangible assets or as inventory. And based on this decision, we will, as accountants, will work on the company accounting. As well, you need to describe business model, revenue streams, as I mentioned, and indicate how costs are, let's say, recognized when you have anything to deal with crypto assets. This is just a note from a company which used some kind of cryptocurrency, and this note I just included for indicating that by first two sentences we receive very important information that crypto assets are treated as inventory, that we use first in, first out cost valuation method, and if the market price, let's say, drops below purchase or cost price, we need to do impairment.
And I'm just a bit interrupting a colleague. So Augustus jumped in straight into the matter. So we're starting from general overview and theory, and then later on Augustus will jump into very specific hands-on case studies. So
so from theory perspective, as I mentioned, there are two possible ways to treat crypto assets. It can be either intangible assets or inventories. Intuitively, you would like maybe to treat cryptocurrency or crypto asset as normal cash, but that's not how how we should treat it. IFRS explained that there are only possible two ways to treat crypto assets, and it can be either intangible assets or inventory. Under accounting treatment, under intangible asset, let's say, accounting treatment, it's pretty straightforward, and we treat it as intangible asset, where we recognize like balance sheet value at purchase cost. End of financial year, we must check for impairment losses, because in general, in theory, we can write the value down, but we cannot write the value up unless we use revaluation method, which can be a choice if it's, let's say, if company chooses to invest into Bitcoin and keep it for, let's say, capital gain. Under inventory treatment, we have exactly same logic. We recognize balance sheet value at purchase cost. What is important to mention is that we can choose first in, first out, or average or weighted average cost valuation methods to calculate cost of sales. Now, on specific cases and case studies. Imagine that the case where a company just purchased one Bitcoin as investment, price is 50,000 USD on 1st of January 24.
So before you just continue, to make it simple for the audience, so if how would you, in 2 sentences, say when you choose inventory and when do you choose intangible asset treatment?
Intangible asset should be chosen in case company does, I don't know, any ordinary activity of company is not related to cryptocurrencies, to let's say any crypto tokens and so on. And let's say company just wants to keep it as an investment and play, let's say, Bitcoin on speculation method, like to speculate for company gain, let's say, for income. In that case, it should be treated as intangible asset. And let's say if a company is a trader or a broker, where company's ordinary activity is involved in trading Bitcoins or trading other cryptocurrencies, then company should treat it as inventory.
Good.
This is like simplified, but more or less explanation how to treat it. So in this case, let's say we would just record intangible asset increase of 50,000 and credit bank for 50,000. This is straightforward. This is just recognition at purchase cost value. Then if, let's say, intangible asset value decreased by to 45,000 by 31st. What I mean, the value changed, so the market value dropped to 45,000. We need to check for impairment loss, and we should debit P&L impairment loss on intangible asset and credit intangible asset on balance sheet. We would reduce the value by 5,000 by 31st of December. Now, if second example is, let's say, if the value increased, we could not show this increase under profit and loss. So this is a difference where we can write down Bitcoin value. Let's say we can check for impairment and write off costs to P&L, but we cannot increase the value and write income, so to say, under P&L. The only possible increase we can do is under other comprehensive income. So we would debit intangible assets and credit other comprehensive income. So this is super important, because even if Bitcoin value increases twice, let's say, by end of the year, you could not record P&L gain until you do not sell the asset. This is main differences between revaluation and cost method under intangible assets. But in general, the only difference between these two methods is that increase in value could be recorded for revaluation method under other comprehensive income, and under cost method, we should not show it until we sell the asset. Now, talking about inventory, imagine the case that company purchased 10 Bitcoins for resale for a price of 50,000 USD per unit. So this, by this transaction, we would record purchase cost of 500,000. We would debit inventory, credit bank for the same amount. Now, after a few days, we purchased 3 more Bitcoins for lower price, and we record inventory increase by 138,000 and bank decreased by 138. Total value of full Bitcoin inventory is 638,000, and we have in stock, let's say, 13 Bitcoin. Now, under first in, first out method, let's say company sold 12 out of 13 Bitcoins for 51,000 USD per unit. What happens? We need to record cost of sales, and cost of sales are recorded by taking 10 Bitcoins, multiplying it by 50,000, and summing up with 2 Bitcoins multiplied by 46,000. We get total value of cost of sales, which is 592,000, and we write off it from inventory to cost of sales. At the same time, we record revenue of 612,000 because we sold 12 out of 13 Bitcoins. Now, what happens if we have inventory valuation under weighted average method, and we sell we have exactly same case, we sell 12 out of 13 Bitcoins for 51,000. We would calculate average price per 1 Bitcoin. So we pretty much sum total costs, we divide it by 13, and we get that 1 Bitcoin value is 49,000 approximately. Then we would multiply 49,000 by 12, and we would get 588,000, which we would need to write off to costs. So we credit inventory in balance sheet, and we debit costs under P&L. And on the same time, we record revenue from sale of Bitcoin, 612,000. And you can note a difference that under first in, first out method, we had 20,000 of revenue from this transaction. Sorry, not revenue, but gross profit. And in here, we have 23,000, almost, actually even more. Yeah, so choosing how you evaluate inventory is super important, and it will be, you will have slight differences on cost of sales, and that will change your gross profits. Now, last case, let's say I wanted to include is if this inventory value, we still have 1 Bitcoin end of the year. So let's say if the value of Bitcoin drops to 40,000, then we should check for write-off or impairment of inventory, and we would need to reduce inventory value by 9,000 end of the year. So we do this by reducing value under inventory and increasing cost of sales by 9,000. And to sum up, I just want to say that digital assets by IFRS can be treated either as intangible assets or as inventory, as you saw the differences. This is the most important part to include into accounting policy. How do you treat it, and which method you will use, and keep communication with your accountants as simple as possible. Explain how business works, and that is the key thing. And as well, I would like to emphasize that we as accountants as well communicate with auditors and lawyers, and for audit reasons, we need to agree with auditors how to, let's say, treat cryptocurrencies, and I want to give a lead to Thais on the audit perspective of cryptocurrencies. Thais, maybe you could take over.
So just to wrap up, by the way, Augustas shared some quite a lot of also more text than he spoke, and he commented a lot. So as we know, you can you under request you can receive the slides, and if any queries you can reach out to us. And yeah, so of course with any kind of good accounting, you need a proper auditor, especially when you come into audit obligations, and specifically when you're a blockchain company. And and good audit matters. Yeah, so we hand over to Faiz.
Yeah, thank you for the introduction. So greetings, everyone. The goal here for my part of the presentation is to share some of my insight and experience as an auditor for the most common scenarios that I run by. And based on these, my goal here is to create a value for you by sharing that knowledge and insight so that you can reflect this on your own company or by the company that you're working at as a CFO to see if this is also useful for you. And that is so that you are prepared the best way for the upcoming audit, so you can have a smooth process like Jacob mentioned early on. So besides this, I work along with 17 colleagues to provide trust to the financial statements that we provide and sign, and to provide comfort for the business owners that they are in safe hands and by sharing insights about their businesses throughout the audit. Okay, so preparing for the audit, it is getting your act together, meaning that if you have good accounting like Baltic Assist or with qualified CFOs who make sure that the bookkeeping is done correctly, making sure that the receipts are being booked accordingly, then you are already far ahead. But of course, before finalizing the books, go make sure that you go through the accounting estimates by the end of the year. For instance, is there any impairments for the debtors, the assets, the development projects, or etc. It sounds easy to go through that checklist, but often that's not how we see it. This can often lead to a bad process throughout the audit, and which will lead to audit overrun. But as in every relationship, it comes down to communication. Clear communication and meetings in advance is always a good step towards a good process. So we at our place also always have the meetings at hand to understand the businesses and the internal controls to the specific risks that the business are in, because then we can address it more properly and also create better value for the business. And this is all to make sure for a clean and smooth process. And if this is not done properly, then it can easily be quite clumsy, which is of course frustrating for all parties. It's always a good advice if you are super busy driving ahead with the business, then it's of course good to outsource some of the areas to free up times where you can create the most value for you and the business. So one of the topics that I would like to address here is the accounting for development costs. It's mostly useful for when starting up a new company. For instance, within this industry, typically it requires a lot of capital and to fund the development process, and in order to develop the desired product or service, then this can either be funded by yourself, but in most cases, because it relies on quite a lot of capital. External capital injections are mostly needed from investors. And when they do this, they of course look at the business plan for the development project, but they will also like to have a look at the internal figures of the company, for instance, the latest annual report or the budget for the upcoming period. And here it's important to be aware of the accounting principles for development costs on how to allocate and present for these. Some of the most type of the cost are reflected here, but it of course varies depending on the company. In most cases, the business owners chooses the easiest way to present an account for these, and that is to drain them all in the profit and loss section, where it's being accounted for as an expense. When you're allocating all these costs as an expense and with no revenue yet, then your equity is in most cases gone in no time, leaving you with a negative equity. Negative equity and losses for the year does not look good in the eye of new potential investors, and is of course misguided information from the viewer, because they do not have the knowledge of the great product that you are working and developing. So here's a brief example of the P&L, with the P&L assets and liabilities, and doing what most others do. You see a loss and a negative equity if you allocate these directly in the profit and loss section. However, there are actually two ways where you can account for these development costs. The one reflected here is the easiest way. The other is where you need to determine whether or not they should be capitalized. So should they either be capitalized or expensed as incurred? So instead, if you capitalize your development costs, you allocate them on the balance sheet under intangible assets. This means that all costs relating to the development project, including salary, external expenses, etc., they are to be presented under the intangible assets, and you can only first start to depreciate on this balance once the development project are finished and in use, or of course if there's any other impairment indications during when you are making this project. So this is, in my opinion, a better way to properly reflect on your annual report the cost that you have been put into the developing of your new project. So what is the catch of classifying your cost this way? Well, there are some requirements. And first, we need to define what is a development project. In order to be defined as a development project in this scenario, it needs to be a development of a new product. It can either be a prototype, a new machine, new software, and you need to have a business plan for it, where you need to plan for running the tests. For larger companies, it's obligated to do this way and present all their development projects. But for smaller company, you can choose to apply these accounting principles as well. But it requires some great internal controls to make sure that you are fulfilling these requirements. And what does that mean? It means that you can document to an auditor that the expense are being directly related to the ongoing project, or that one of the employees that their time has actually been working on the project. And this can be on the time registrations that they are tagging, that they spend etc. days working on these projects. Failing to do so means that you have to expense all these costs. And Another thing, if you're choosing to apply these accounting principles, it means that you have to do it for all your new development projects. So in all, why does not all do it this way? It of course gives more administration, and there are some strict requirements, but with a good bookkeeper and an auditor who can assist with the correct setup, then it's not difficult at all. And also, in my opinion, it provides a more true and fair picture and understanding of how much cost it has required to develop the given product. So each year, each project has to be evaluated in order to determine if all the requirements are still in place and if there are any impairments of the projects. Tax-wise, there are no difference if you do it one or another way. So another thing, when applying these accounting principles, you are obligated to bind a reserve on the equity. This means that the cost incurred in the year that are being presented under intangible assets, less the tax effect, is binded as an restricted reserve. This is shown for the reader of the annual report that if these principles are in use, then how would the free reserve have been? How would that look if you would have just expense all the cost along the way? So in this brief example, the first tax effect is not included, but it shows roughly what would happen if you had the restricted reserve. It'll say if you're having 100 cost after the tax effect for development project, then you would bind that on a restricted reserve and have negative free reserve. Okay. And another thing, here in Denmark at least, there are some initiatives from the tax authorities to help research and development projects where you actually get an increased tax deduction on your development projects. However, it means that if you're having in 2028 an expense of 100, you get 120 in tax deductions. The rules for this area are quite strict, and they're quite strict about what types of projects and costs that they apply for. We usually say if you can take patent on the project, then it's subject to that these increased tax deductions applies. In all instances, we always advise that you consult with an auditor or tax specialist before doing so. Then also there's another initiative in Denmark. It's called the tax credit regime, skattekreditordningen, and it's an initiative for the Danish government that they want to support the research of new technologies or products. And what it means is that the value of the tax laws, you can get that repaid to the company. Meaning that normally when you have a tax loss of 100, you can utilize that tax loss in future profit. But under this regime, you can actually get the tax value repaid to the company. Meaning if you have a tax loss of 100 and these rules that are applied, then the 22 will be repaid to the company. However, have in mind, we do see that some cases where it is a software project that it is not supported within this tax credit regime. So, as said before, if this could apply for your company or for the business that you're working at, we always advise to consult with an auditor or to get a binding answer from the tax authorities in advance, just so that you avoid that it's either being denied and you accounted for getting the tax repaid, or so that you avoid that they can have to get you to repay this later on. And also, I know we have a tax expert later on, but I found this useful within this industry. There are new tax treatment for development of software and also for software licenses that are acquired. Until now, as well as patents, buying or developing this software, the cost for this could be immediately depreciated. But as of 1st of January 2025, this option will no longer be available. And this means that that cost to either developing software or for acquiring licenses to software, it needs to be treated as a fixed asset, and actually means you cannot get 100% depreciation write-off annually. Now it is capped at 25% annually. And as with other assets, you can only begin depreciation when the asset or software is in full use. So we have raised some questions to the tax authorities of to get a better definition of which software or for which example that these rules applies. But as this is quite new, we have not yet received the answer on some of those. But it can be quite exhausting for some companies where they are developing new software and that they cannot begin to depreciate on these costs until that they are have finalized the product. So this is a game changer for some of the companies. Okay. And then there's I would like to briefly talk about going concern. So going concern is another major topic for whenever finalizing the financial statements, because whenever the management are preparing the financial statements, it must assess whether the business can or should continue operating for the next year, meaning if there's liquidity enough to fund the company for the next year. And this is called the assessment of going concern. And this is very important because if the company does not have enough or sufficient liquidity to be going concern, then this must be expressed in the financial statements. So this can and is often a battle to provide and to ensure that there are enough comfort that the going concern assumption is applied. So if management highlights in the annual financial statement that there may be some uncertainty about the company's ability to continue operations, then not only does the management in a note, but also the auditor must emphasize this in a supplementary note. And if the auditor believes that there are some and still uncertainty, then and this uncertainty is not fully disclosed in the financial statement, then the auditor must issue a qualified opinion due to the lack of this information. So it is quite important and sensitive topic, because of course all business owners, they want to make sure that and believe that the operation is going concern, but it can be quite hard for some startup or developing companies to fully provide this comfort. So what can you do to not end up in this situation? You can plan in advance with your auditor to avoid these unnecessary stops in the audit process. You can lay down a liquidity budget saying, okay, what are the cash burn for the next 12 months based on the current expenses, and how does the funding look at? Also, if there are some uncertainty, you can get a letter of support from either one of the owners of the company or a potential investor, where this letter of support says that if there are any lack of liquidity, then this investor or owner will provide the necessary liquidity to make sure that the company are able to pay its bills as the expense incurs over the next period of 12 months. And also, when is a state-authorized public accountant needed? In Denmark there are some rules set for when it is required, and the limits for those is that if the balance sheet is above 4 million, the revenue is above 8 million, or the number of employees is higher than 12. So 2 of these 3 limits, they need to be exceeded for 2 consecutive years. So with 2 consecutive years with net revenue above 8 million and above a net balance of 4 million, then you are subject to audit. And if you are subject to audit, then it's either a full scope audit to the right, who provides the maximum degree of security from the opinion, or it can be an extended review, what we in Denmark call the udvidet gennemgang. And if you are below these thresholds, then you're typically not in scope of audit, and then you can either run by with no opinion from the auditor, or just an assistance opinion from the auditor. We do see that many banks, and also for investors, and also other who are interested in the annual report, that having this for having an auditor on attached to the company provides better trust and better comfort for the numbers. And now, when we have discussed a lot about the audit, I want to introduce Kasper and give the word to him, so we can get deeper in the tax aspect.
Perfect. Thank you very much. So I have this brief introduction of myself in the beginning, and I would like also to tell something about the company I work for, Dahl Law Firm. We are one of Denmark's 10 greatest law firms, and we especially focus on cryptocurrency taxation, and also we have like branches of the company focusing on for example gaming and tech software as well. So I will start the presentation, and in the beginning I will talk a bit about the general things that you should be aware of when looking at tax on cryptocurrency in Denmark. And I would like to state that cryptocurrency basically are subject to taxation under 2 distinct regulations. The most common and the thing most people are taxed under is statsskatteloven, which states that cryptocurrency will be taxable if it's acquired in speculation. And Bitcoin, Ethereum, Trump meme, etc. will be filed under this law. how do we understand if someone speculates? Because common sense, if you think that something will increase in value and you buy it on that purpose, that will be speculation. But we see a lot of persons interested in cryptocurrency, buying cryptocurrency, and actually use it for a purpose. So is that speculation? Will it be taxed or not? So if we look at case law, it dictates that in general it's sufficient that it's a not insignificant element of the acquisition is speculation. So by that, the general rule of thumb is that if you buy cryptocurrency, the tax authority will see it as speculation. The second branch of how cryptocurrency is taxed is the Capital Gain Act, also in Danish called Kursgevinstloven, in which applies on, for example, stable coins. And the difference between these two kind of taxation is that it's an inventory taxed base income instead of realization income. So I have brought this figure to outline some of the difference and similarities between taxation of businesses and private individuals. And what you can see in the top about the companies is that in the end, it's all corporate tax, meaning that you will be paying 22%, whether it's stable coins or Bitcoin, etc. In contrast, we have private individuals who are either taxed by capital gain or from the speculation, in which when you sell, for example, Bitcoin, Ethereum, etc., you will be taxed as personal income from the gains, and there will be a deduction which is only proportionally when you have a loss. And actually, if you have like a normal salary payment or in the higher end, you will be paying 27% more in tax than what you have in the proportional deduction. To understand tax in Denmark of cryptocurrency, it's crucial to understand the realization principle, because every realization of Bitcoin, Ethereum, etc., will trigger a tax-relevant event, resulting in either a tax liability or a tax deduction. And in the tax authority's view, realization can occur through different through sales or other form of disposal, such as exchange, redemption, or similar transfer of rights. And in general, you have to be aware of that if your transaction doesn't involve a transfer between your own wallets, you should really look up to it or into it, or seek legal advice if you cannot find the answer yourself. Just last week, we had a binding answer from the tax authorities stating that it's actually possible to start a crypto-backed loan and not realize your cryptocurrency in that way. So that's actually very interesting, because if you bought Bitcoin, Ethereum in the beginning and you have a very low acquisition cost, this is maybe a potential for you to use some of the money without getting taxed in the front end. And you're welcome to like send me an email or contact me if you want more information about that. In general, it's very important to understand that it's possible to require a binding ruling from the tax authorities to allow the tax authority to determine in advance a specific situation, whether it will result in a tax liability or whether it will not. So I have the last slide here of general tax, and what's important to understand is that private individuals cannot offset loss against gains, and this means that individual must put gains in one tax bracket and losses in another, and this means this asymmetrical taxation. The second part is how you calculate the gains and losses, and the general practical rule of thumb is that the profit is calculated using the FIFO principle, meaning first in, first out, and this means that the first acquired cryptocurrency will determine the acquisition cost for the first sold cryptocurrency. The practical exception from this FIFO principle is that if you are able to identify the specific cryptocurrency, you can perform asset by asset calculation. So I have this example because what is the consequences that you use the FIFO principle? So back in 2017, you maybe bought one Bitcoin for 20,000 American dollars, and today you buy it for $100. And tomorrow you think, well, the price will go down. You sell the one Bitcoin, and this means that you actually sold the first Bitcoin that you acquired, and that will result in a massive tax, and you have to be aware of this. It is theoretically possible to keep on trading cryptocurrencies continuously without taxing the earliest acquisition. As I say, it's theoretically. So what I will do is ask a binding answer and separate different wallets to assess each cryptocurrency. In the next part, I would like to talk a little bit more about what we see from a lawyer's perspective in regards of cryptocurrency. I have the agenda here, and I'll sum it up as I go by. First of all, I would like to tell a little about the Danish tax agency's control measurings. And the first one is the project money transfer, where the tax agency receives information about cross-border money transfer to and from Denmark. If a case is selected as a part of project money transfer, you must document that the transfer involved funds that had already been taxed. And if you cannot meet this burden of proof, well, you'll be taxed as a one-to-one increase of your income of the money that have been delivered to your account. Secondly, we have DAC 8 and CAF, which is international agreements regarding automatically exchange of information from providers of crypto services, such as trading platforms. And they will send the information directly to the relevant tax authorities beginning 2026. In the end, we have material request, which is the Danish tax agency's chance to request information from the specific taxpayer about their cryptocurrency activities. So I brought this slide to show you a typical case at the tax agency, where we, on the left side, at first see that the tax authority requests information about your cryptocurrency. This can either be a general request or because they got information from project money transfer, or as well in the coming years from DAC 8. What you do next is that you or yourself submit some information about this, and I would really come with some comments about how this information should be understood to make sure that they don't misunderstand what you have done with your cryptocurrency. Sometimes we will request access to documents at this early stage to get information about what information the tax agency already has about the taxpayer. The tax agency will then receive and review this information and either draft a proposed decision or ask for more details. And we recommend that you provide a comment to these proposed decisions unless the tax authorities agree on all significant points. These comments can help you adjust the tax amount and also discuss the appropriate standard of liability, which could affect any penalties. And when the tax agency feel like they have all the information and you had the chance to comment, they will make a decision. In the end, it is possible to appeal this decision, for example, to the Tax Appeals Board, and you have to be aware of the 3-month time frame for making this appeal. It's very important to read the entire decision when you receive it, because in the bottom they will all often refer whether or not the case will be referred for criminal assessment by the tax authorities criminal unit, and if it is mentioned, we will strongly recommend you to contact a lawyer that can help you determine whether it will be an advantage to present your perspective in an appeal case. So what happens if you haven't paid your tax correctly? The tax agency will send you this decision, and you will have to pay the outstanding taxes. If there is a penalty case, there can be either a fine or actually jail time, or you can go free of punishment, depending on how they see the case. This isn't meant to scare you, but this is the ultimately consequences if you intentionally avoid paying correct taxes. So we work with different kind of liability standards. In the lower end, we have simple or ordinary negligence, which is failing to comply with the law on of how a reasonable person would do in similar circumstances. Then there will be no punishment and no consequences. Then we have gross negligence, which is failing to take reasonable care or to avoid this tax error. And it isn't intentional, but it shows a significant lack of attention. What we often see is that the tax authorities state that if you haven't filed correct taxes on cryptocurrency, this will be the standard they try to put over you, and a minimum of gross negligence. In the end, we have intent, which is the intentionally action to evade taxes, such as falsifying records or underreporting income. And this is a wishful act, and this will have big consequences. So I brought this slide to show you in what circumstances we talk about a fine and what circumstances we tell about potential jail time. And there, what you can see is there's a big difference between gross negligence and intention, and that is why it's very important to handle the liability standard throughout the control case. Yes. What do you do if you haven't paid your taxes for the last 4 years or just the last year about cryptocurrency? Maybe because you didn't know the rules, or if you just wasn't aware, then it could be a good idea to make what we in Danish call an selvanmeldelse, which is a way where you not only will be able to sleep well at night, but also reduce or avoid any penalties. If the case can be settled with a fine, normally criminal liability is generally not pursued, or even better is if it wasn't intended, no fine will be given. And the same applies for intentional evasion below 100,000. What you have to be aware of here is 100,000 for especially a private individual isn't that much in regards of cryptocurrency, because if you trade a lot, the asymmetrical tax will cause a high taxable income that you don't have a deduction for. So to get a penalty reduction, you'll have to need to hand over the information voluntarily, and you should do it as soon as possible, as there will be no reduction if the investigation is ongoing or you think the investigation is near, since the tax agency almost have solved the case themselves. The rules are a bit complex here, and please feel free to reach out if you want to know more about this possibility to make a selvanmeldelse. We always recommend that you seek legal advice, since a good lawyer will be able to pin out the circumstances that of why you at maximum have acted with gross negligence, and it wasn't intended that you didn't pay your taxes. Ultimately, I believe that most people in Denmark want to pay the correct tax from cryptocurrency, and the reason why they don't pay the tax is they have a lack of knowledge about the rules. The next slide is about the rightful owner of the cryptocurrency, and it's in general very important to understand who owns the wallet, and also, for example, a wallet on a trading platform. Because if there is a company owning cryptocurrency and the person trading is the wallet where the trading is going on belongs to the private individual owning the company, there will be a mix and also a tax to pay because of this mix. So please be aware of this. One last thing before the summary is that the worst thing that you can see in a decision is that it states there is undocumented deposits. Undocumented deposits are deposits where you cannot document the price, time, place, and where you bought the cryptocurrency. The consequences are that you will be taxed of the full sale price of the cryptocurrency, and you cannot deduct the acquisition cost. So we have this example on the right side, where a person buy some Bitcoin or some cryptocurrency for $3 and he sells it for $4. If he has the documentation, he will be able to pay just $1 in tax. And if he does not have the documentation, he will pay $4 in tax. And by that, end in problems. What you're going to do when you find out there is these undocumented deposits is that you search all transaction on-chain, off-chain, and find this documentation so that you can send it into the tax authorities. And also it's important to make this a part of your day-to-day work, like find out, I trade on this platform or I use this platform. Is the documents saved for documentation later, or is there a chance that this company will file for bankruptcy and you don't have a chance to find the information of the transaction? So keep supporting documents from this, and also maybe have an Excel sheet. So in the end, there is just these four summaries. First of all, ensure that your wallet are belonging to the right person. Ensure that you are continuously monetizing and maintain documentation of your purchases and sale. Expect that your company may be subject to audit from the Danish tax agency. Consider seeking assistance from a lawyer or an accountant during an audit from the tax authorities, and consider filing for voluntary disclosure if you find out that you haven't paid the correct taxes. And also, in the end, for foreign companies, we have some special rules in Denmark stating that if you have your if your business, just one moment, I'll find it. That your management is located in Denmark, there is a chance that the company will be fully taxable to Denmark, and this is a very important thing to seek out and find out if there is this risk. So I think, Jacob, we are ready for the Q&A.
Yes, thank you very much, and thank you everyone for really good presentation. The topic is quite a large topic, and just having 15-20 minutes each to go through it, I think really well done. We already, like even prior to this, and as well we got a couple of questions from the audience. The first one will pop up just in a moment on the screen as well. Yes, this is a good practical question. It goes like, what do you actually do? Do you use economic? Do you use a normal accounting system? Or from a practical approach, what do you actually recommend, and what do you see out there? I think that would go for Baltic Assist.
Well, I can just comment in general. Any kind of ERP does the same job. So I mean, from accountant's perspective, it's there's no big difference. But if we're working with cryptocurrencies, particular importance is data movement, and of course you have to bear in mind the compliance of local rules. So, for example, in Denmark, there's a list of approved softwares, and most popular is economic. However, we find it most practical working with cryptocurrencies is like Business Central or Uniconta. However, in general, we're not limited to any kind of ERP, and any kind of ERP can do the job as long as it can be integrated with the platform, or there's easy data movement. So that's so Uniconta from that perspective works well.
I would maybe highlight that in Denmark, especially, there's a list approved by SCAT, I think, or who approved that. I don't remember, but there's a list of accounting systems which can be used. And for us, it's important that it would be easy to manipulate with a lot of data in Excel, and we could easily upload it, extract it, and so on. So it's
great. And hey Kenneth, good to see you. I just saw your comment. And from an audit perspective, it doesn't really matter, right? Or you just need the balance sheet? Or
for the audit perspective, you just need to comply with one of the whitelisted systems. We do often see systems like Economic and Uniconta, but if there's a better system, there might be, but indeed it needs to be on the whitelist. Yeah.
Great. Thank you very much. I think we got a new question here popping up. Yeah, that's a good question. I mean, I'll just read it out loud. Like, how did it actually work? Like, people normally doing it, outsourcing it. Like, is it easy for accountants who haven't worked in blockchain to learn blockchain accounting?
So it's a two-part question. So the first part is whether it's in-house or outsourcing. So I would say it's a similar trend as in any other business areas. In the past, people were more conservative and just hiring in-house, but in general, it makes sense more to outsource for multiple reasons, and it doesn't matter actually on the size of company, unless your company has a big brand name and you can afford to attract competent finance people. Otherwise, it can be very difficult. So So when you outsource, you don't just hire one person. You receive services where that particular person or team can consult with other people, and there's a knowledge sharing and etc. And also it can be cost saving, especially when the the workload doesn't require full-time person and etc. But also it's regardless of the team size. Even we work with big size clients, so it's not a big deal. And whether it's difficult to learn, so
Maybe I could.
yeah. So
take this
Augustus
one.
can comment more.
Yeah, so in general, we had two very different, let's say, experiences. One very good and one not so pleasant, let's say, because we had few customers, and in one case, it was super hard for us to learn because we didn't understood the business, we didn't understood the money movement, the let's say crypto wallets used, some how it was separated and so on. And other case was where let's say director of the company came to us to visit us in Lithuania. He basically said, look, this is like the business idea, we get revenue for this, our crypto wallets are here. And it was pretty much explained in a very straightforward way. So I would say it's not hard to learn for competent people. It's just how we get the information about the business. So once we have everything about the business, it's pretty easy and straightforward.
Yeah, because in the end of the day, I mean, the accounting rules and treatment, it's the same accounting, just specific principles. So it's more about learning about blockchain for the accounting and for about the business model.
Okay, great. And now we have another one. So a list. Lesher, would you like to put up? There we go. Thank you very much. Yeah, what are the top 3 things that a company that's operating in blockchain should be aware of from an audit perspective? I think, like Thijs, you went through a lot of interesting things, and again, like there's a lot of information to grasp. So, what would be your like top 3 important parts?
Okay, so we have to narrow it down to the 3 top things. Well, I think Casper was commenting on this as well. The wallet needs to be owned by the company if it is within the company. We do see some that they made an individual registration to one of the exchanges instead of a company exchange. This is a red flag. And also when it comes down to especially crypto assets, it's very important to document the paper trail. Where does it come from? How did you invest to begin with? Because from an audit perspective, it all comes down to how to document each of the transactions and where did the money come from and who did you exchange with. If you start from 0 and up with 100, you need to document and provide insights on how you came from A to B. And also, it's very good to plan in advance and to consult in advance. We do see often that the clients, they often come forward once the damage is done, after they got a letter from the tax authorities or one stating that hey, there's a red flag here where you need to document. So plan in advance.
And I just want to add one quick comment that, like Faiz mentioned, and we, before we mentioned, so the transparency is very important because we need to record transactions and we need to have proof why there's a specific movement here and there, and we need proper explanations on the money trail and when what was purchased, also as Casper mentioned. So in practice, we require those documentations, and we had experience where crypto client was very easygoing, and then year end came, and they were not that easygoing at that moment. And so bearing in mind there's a snowball effect. So if we don't gather proper documentation, then comes audit, FICE goes through audit, and and if during audit you cannot, because when you're looking at the past, especially if there's a different movements in wallets, it's hard to track what's happened in the past. Then, and if they let go, then you might get a tax investigation, and then Casper comes in. Yeah.
Planning. Casper, do you maybe want to add something in here?
Yeah. It's very important to keep the documentation. For example, as I wrote on LinkedIn the other day, when the Trump meme coin came out, I think at the moment you cannot buy it on, for example, Coinbase, because Coinbase is like a closed product where you can, like, for example, as we can do it in Saxo Bank and so on, you can take out the documentation directly from this. But to buy this specific coin, you have to like transfer it from your Coinbase or Binance account out on a specific wallet, and then you have to buy it from there. And if you cannot keep track of these transfers from one wallet to another and keeping the slate clean, you cannot document your acquisition cost. And this is like, it's quite a big. For example, if you buy for maybe just 10,000, 100,000, you will get no deduction, and you will pay the full amount on tax. And you cannot get a deduction if you lose money. So it's very important.
Yeah, that's a really good point. There's one more. This is actually aligned to you, Casper. What is the most common mistake companies do from a tax perspective? Is that buying presidential meme coins? Or?
I think Thijs actually said something good about that, because people are often not aware whether a wallet is a company wallet or if it's for the private individual. And if there's a mix between money between this can actually be a taxable income for the shareholders, as distinct dividends, maskeret udbytte in Danish. And what is the problem there? Well, if you transfer the money back, there will be putting money that you have been given in dividends back in the company without any tax positivities, and then you maybe take it out of the company again, and then you will be taxed of this income once more. So it's very important to have like different kind of what is for you personally and also for the company. One more very important part is that I feel like some people are trying everything at once and doesn't really think about the tax perspective. So they try this, and they don't really think about what are the tax consequences of doing this. For example, if you have a loan agreement on cryptocurrency, we have this decision just a couple of weeks ago, where they state that this is no realization of the income. But if the document or the loaning agreement was different, there will actually be a realization, meaning that will be a taxable income. So if you're not aware of these different kind of tax perspectives, you can be in big trouble because you don't don't get the money of it in the end. It's only a cost for you.
Really valid point. And I think it goes back to like at least what I was advocating for, the whole planning, right? Like if it's regard audit to a company, I mean, maybe test around privately, and then when you do it in a company, it's important. It's done correctly. I see there's one more popping up, and yet this goes a little bit overall. Do you guys feel that people are unsecure about tax law in general? And again, it goes back to what would you recommend? It seems like there's a lot of unsecurity in regards of taxation in general. So what would again, could be a broader question. Like, what is the suggestion here? Is it just planning, or is there anything else you would like to advise on? I mean, I can start from maybe, let's say, from a company perspective. At least what I really learned is that there's cases where it's a little bit unclear. Like Tyson mentioning, if you just mentioned there's a new law or a new case came out like a couple of weeks ago, we always kind of tend to say, let's keep it safe when it's done in a company. Let's not try to experiment something because it can have huge consequences for the company. So I would at least like really recommend that, like simplifying the things you're doing on chain. Like if you want to test things out, which could be for a new business model, do it in a close, non-financial environment. And I think that's really, like, at least would be my advice. Like, really make sure you understand the law. Let's make sure, like when we started out in 19 with the first law, audit on the firm, like we had a lot of companies who were doing things that was quite hard to translate into it. It was extremely complicated because we had to figure out it on the other side, right? So I think I would recommend, like, really just make sure, keep it simple. Don't try to experiment too much unless you actually got your accounting trail, your audit, and your legal in place.
Indeed, and also focus on what you are good at, and when in doubt with this, consult with someone who has that knowledge, because the tax penalties can be quite strict.
And I just want to maybe make a quick comment that, I mean, from the accounting perspective, of course, this question probably was also from personal perspective, but from the business perspective in accounting, because blockchain technology is still relevantly new, especially in comparison that how many years, accounting is existing. So there's still only mostly regulations Europe-wide, sorry, not regulations, recommendations how to treat everything. So from day-to-day basis, it's still quite simple as a
and cases are basically still, there's no standard from IFRS to describe how to treat it, let's say, in the right way, and it's taken case by case with different business and models.
We're actually running overtime, but like when you talk about audit and tax, like time just fly by quite fast. So I would like to thank you all for listening in. Really happy so many people wanted to hear about audit, law, and accounting in blockchain companies. I want to thank the panelists for the presentation, and we will do some posting after this webinar to share some of the content. So we really urge you guys, if you have any questions, just please reach out. And if you're in a company and documentation is too expensive to use an auditor or accountant, then the easy question replies that then you probably shouldn't do it, right? That is not a viable business model. So really invest in a secure environment that would make your life a lot easier. Thank you, everyone.
Thank you.
Bye.